is the DCF method applicable in case of ongoing projects? So when you say ongoing projects, we will need to look at two things. Number one, as to when you say ongoing project, what do you mean? And number two, the purpose for which we want to do the valuation. So remember, there can be two situations. Situation number one is a greenfield project, and that you want to do the evaluation of. And number two, it is a running company, and that company has taken another project which is going on, and so that is the second situation where you want to do the evaluation. So your question is whether discounted cash flow method can be made applicable in case of both these situations, and the answer of course is yes. Answer of course is yes. And why is that? Because obviously, as I said in the very beginning, why do we do valuation? We do valuation because we have to take a decision. So whether it is a greenfield project which is in the process of implementation, or it is a company which is already a running company but implementing another project. So in both these cases, the valuation can be done using the discounted cash flow method, definitely for sure. And the methodology, please remember, will remain the same as we have. So 9 steps that we have discussed will be applicable in case of both these situations. Meaning what? Meaning you want to do the evaluation. First situation, running project in the pipeline, in the under implementation, and somebody is interested in acquiring that project or acquiring company which is owning that project. So how will the evaluation be done using the discounted cash flow? Right. So your cash flow will be divided, as we said, explicit forecast period and the terminal period. In this case, you will have one more period before the explicit forecast period, and that is the implementation period. So during the implementation period, the money is going to go into the project, and once the project is implemented, then during the explicit forecast period, the project will give you cash, and the terminal period also the project will start giving you cash. So what you have to do? How do you do the evaluation? Just project the cash flow during the implementation period, and during the the explicit forecast period, and during the terminal period. So take all the cash flows, find out the present value of all the cash flows, and whatever using your cost of capital, and using your cost of capital, you find out the present value of all the cash flows, and that becomes the valuation of that project. So at that value, you as the owner would be interested in selling that project at that price, or a price which is higher than that actually. So this is how you can use the discounted cash flow for an ongoing project which is totally a greenfield project. Second situation, running company. This is a running company also implementing the project. I don't think I need to elaborate, and I'm sure you will understand. So you again, the cash flow in this case is going to be in the implementation period. The cash flow will be of two projects. One is the project where it's going to be more outflows, and second is going to be the cash flow from the operations, which is existing operations. Project the future cash flows, use your cost of capital, arrive at the present value of all the future cash flows, and that becomes the value of the second situation that we are talking about. So yes, of course, it can be done in both the cases.